What if you never had to worry about money again? What if your investments could pay all your bills, cover your groceries, and fund your dreams without you lifting a finger? Today, we're breaking down exactly how much money you need to live off investments and the specific steps to get there. Most people think living off investments is only for the ultra wealthy. That's completely wrong. The truth is, with the right strategy and realistic expectations, ordinary people can build investment portfolios that generate enough passive income to cover their living expenses. But here's what nobody tells you. The amount you need might be very different from what you think. Let's start with some hard numbers that might surprise you. According to recent data from the Bureau of Labor Statistics, the average household spends about $66,000 per year. That means if you want to live off investments alone, your portfolio needs to generate $66,000 annually without touching the principal. Here's where it gets interesting. Using the traditional 4% withdrawal rule, you would need $1.65 million invested to generate that $66,000. But wait, there's more to this story. The 4% rule assumes you'll withdraw 4% of your portfolio in the first year of retirement, then adjust that amount for inflation each year after. However, financial experts are now questioning whether 4% is still safe in today's market environment. Charles Schwab's research suggests that with current market conditions and lower expected returns over the next decade, a more conservative approach might be necessary. Some experts now recommend withdrawal rates between 3.3% and 3.5% for early retirees. What does this mean for you? If you use a 3.5% withdrawal rate instead of 4%, you would need nearly $1.9 million to generate that same $66,000 annually. That's almost $250,000 more than the traditional calculation. Let's make this practical with real-world scenarios. Not everyone needs $66,000 per year to live comfortably. Your geographic location, lifestyle choices, and other income sources dramatically affect how much you actually need from investments. If you live in a lower-cost area and can comfortably live on $40,000 per year, you would need between $1.14 million and $1.33 million invested, depending on your withdrawal rate. That's still a substantial amount, but much more achievable than the higher figures. For those who want a more comfortable lifestyle requiring $80,000 annually, you're looking at needing between $2.29 million and $2.67 million invested. And if you want to maintain a higher standard of living with $100,000 per year from investments, you need between $2.86 million and $3.33 million. But here's a game changer that most people overlook: Social Security. The average retired couple receives about $33,000 annually from Social Security benefits. This single factor can cut your required investment portfolio in half. If Social Security covers $33,000 of your annual expenses, you only need your investments to generate the remaining amount. Let's revisit our $66,000 example. With $33,000 from Social Security, you only need $33,000 from investments. Using a 3.5% withdrawal rate, that means you need about $943,000 invested instead of $1.9 million. That's a massive difference that makes living off investments much more attainable. Timing is everything when building wealth. The earlier you start, the less you need to save each month thanks to compound interest. But even if you're starting later, there are specific benchmarks that can guide your progress. T. Rowe Price provides excellent guidelines for savings by age. By age 35, you should have between 1 and 1.5 times your annual salary saved for retirement. If you earn $75,000, that means having $75,000 to $112,500 invested by age 35. By age 50, the target jumps to 3.5 to 5.5 times your salary. That same $75,000 earner should have between $262,500 and $412,500 saved. And by age 65, the target is 7.5 to 13.5 times your salary, which would be $562,500 to $1,012,500 for our example. These benchmarks assume you're saving consistently, earning reasonable investment returns, and planning to retire around age 65. But what if you want to retire early and live off investments sooner? Early retirement requires more aggressive saving and larger portfolio targets. If you want to retire at 50 instead of 65, you need to account for a longer retirement period and potentially lower Social Security benefits. This typically means needing 25 to 30 times your annual expenses invested, rather than the 20 to 25 times suggested by traditional retirement planning. Now let's talk about how to actually build these portfolios. There are several approaches to generating investment income, each with different risk levels and requirements. The dividend investing approach focuses on stocks that pay regular dividends. A well-constructed dividend portfolio might yield between 3% and 4.5% annually. This means if you have $1 million invested in dividend-paying stocks, you could receive $30,000 to $45,000 per year in dividend payments alone. The beauty of dividend investing is that you don't have to sell any shares to generate income. The companies simply send you cash payments throughout the year. However, dividends aren't guaranteed, and companies can cut or eliminate them during tough times. Another approach is the total return strategy, which combines dividends, interest, and capital gains. This is what the 4% rule is based on. You invest in a diversified portfolio of stocks and bonds, then sell small portions each year to fund your living expenses. The advantage of this approach is potentially higher total returns over time. The downside is that you're gradually reducing your portfolio size, and poor market timing could significantly impact your long-term success. A third option is creating multiple income streams through real estate investment trusts, bonds, and other income-producing assets. REITs often yield 4% to 6% annually, while high-quality bonds might provide 3% to 5%. By diversifying across different income sources, you reduce the risk of any single investment affecting your entire income stream. Here's what most financial advice doesn't mention. Living off investments comes with hidden costs that can significantly impact your required portfolio size. First, there are taxes. Investment income is generally taxable, and the tax rate depends on the type of income and your total income level. Dividend income and long-term capital gains are typically taxed at lower rates than ordinary income, but they're still taxed. If you're in the 15% tax bracket for capital gains, that $40,000 in investment income becomes $34,000 after taxes. This means you actually need a larger portfolio to generate your target after-tax income. Investment fees are another hidden cost. Even low-cost index funds charge fees, and if you're working with a financial advisor, you might pay 1% or more annually in management fees. On a $1 million portfolio, that's $10,000 per year in fees alone. Inflation is perhaps the biggest hidden cost. Even at a modest 3% annual inflation rate, your purchasing power decreases over time. What costs $66,000 today will cost about $89,000 in 10 years. Your investment strategy needs to account for this by either growing your portfolio or increasing your income over time. So how do you actually build a portfolio large enough to live off investments? It starts with understanding your true financial needs and creating a realistic timeline. First, calculate your actual living expenses. Track every dollar you spend for at least 3 months to get an accurate picture. Many people are surprised to discover they spend more or less than they thought. This number becomes your target for investment income. Next, determine what other income sources you'll have. Social Security, pensions, part-time work, or rental income all reduce the amount you need from your investment portfolio. Be conservative in these estimates. Then, choose your withdrawal rate based on your risk tolerance and retirement timeline. If you're planning a 30-year retirement starting at age 65, the traditional 4% rule might work. If you're planning early retirement or want extra security, consider 3% to 3.5%. Now you can calculate your target portfolio size. Divide your required annual investment income by your chosen withdrawal rate. If you need $50,000 annually and use a 4% withdrawal rate, you need $1.25 million invested. The final step is creating a savings and investment plan to reach that target. If you're 35 and need $1.25 million by age 65, you have 30 years to build wealth. Assuming 7% annual returns, you would need to invest about $1,400 per month to reach your goal. But what if you're starting later? Let's say you're 45 with only $150,000 saved and need $800,000 by age 65. You have 20 years and need to save approximately $1,800 per month to reach your target. It's more challenging but still achievable with focused effort and potentially higher savings rates. Here's something that can dramatically improve your chances of success. Flexibility. The rigid 4% rule assumes you'll increase your spending every year regardless of market performance. But real people don't spend money that way. If you're willing to reduce spending during market downturns or increase spending during good years, you can significantly improve your portfolio's longevity. This flexibility might allow you to use a higher withdrawal rate or retire with a smaller portfolio. Consider having a base level of expenses that your investments must cover, plus discretionary expenses that you can adjust based on market performance. Your base might be $45,000 for housing, food, and healthcare, while discretionary spending on travel and entertainment could vary from $5,000 to $20,000 depending on your portfolio's performance. This approach requires more active management of your finances, but it can make the difference between success and failure in living off investments. Living off investments isn't just a dream for the wealthy. With proper planning, realistic expectations, and consistent execution, it's achievable for many people. The key is understanding that the amount you need depends on your specific situation, not generic rules of thumb. Start by calculating your true expenses, accounting for taxes and inflation, and determining what other income sources you'll have. Then build a diversified investment portfolio designed to generate the income you need while preserving your wealth over time. Remember, the earlier you start, the easier it becomes. Time and compound interest are your greatest allies in building wealth. Even if you're starting later in life, it's not too late to make significant progress toward financial independence. The path to living off investments requires discipline, patience, and smart decision-making. But for those who commit to the process, the reward is ultimate financial freedom, never having to worry about money again. Don't forget to subscribe to Frankie Finance for more practical financial advice that helps you break free from paycheck to paycheck living. Like this video if it helped clarify how much you need to live off investments, and share it with someone who's working toward financial independence. Leave a comment below with your target number for living off investments. Your journey to financial freedom starts with your next decision. Make it a good one.